They are also the entire journey till date and how you are thinking of it going forward. So I think that's very important, that storytelling ability in terms of what you are being able to show the investors your vision in terms of what you are looking to build out is very critical to communicate so that they are also aligned from that perspective. And a lot of times we feel founders undersell themselves. They are building something very valuable, but they're not able to communicate that properly to the investors, in the initial meetings. And then what happens is that it doesn't progress beyond a stage, like. So I think that's very important, that you are clearly articulating and communicating what you're looking to build. And more than short term milestones, key what will happen in 12 months, I think what's the long term vision, what's really keeps you awake at night. And what I mean, that hunger and passion should clearly come out when you are communicating to any investor,
Sure.
because that's what we are looking for.
Got it. So I'd like to bring Bhavna into the conversation since they come in at pre-seed level as well, right? So do you think, uh, you know, like as Prayag has mentioned, things around vision or long-term thinking, do you really see that at pre-seed level as well, or is vision something that can develop with time, right? Um,
Well, yes and no. I don't expect every founder to be an excellent storyteller. That is something that we as investors also help, right? I mean, a lot of times this has happened with us where the founders pitching to us, they have an idea of what they're making, but because we have so much market knowledge, right? We as investors, because we're hearing pitches every day, we know what is being built in the market. We can see, okay, what this could potentially become. So we do inform the founder with, what should you pitch like. But I think what I think my other panelist was also saying, right? I mean, you as a founder need to know what exactly are you doing and why. The clarity of vision is very, very important. As in, what kind of change are you trying to bring, with the product that you have. And especially in D2C, there is a change in behavior that happens, right, once the product comes. Plus, in a lot of categories, there's already competition. So a lot of it is marketing game. So storytelling becomes even more important,
okay.
right? So we keep telling, okay, I have seen something similar, but what are you doing different? And if the founder doesn't know the answer to that,
Right.
then it becomes a big problem. As in, you're building something just for the heck of it, just because you know that the market is big. But tell me, how would you become, let's say, better than the competitors? Or how would you reach a, we give them milestones also sometimes. Okay, so let's say you're doing 1 lakh per month. How will you do 1 crore per month? All of that, right? Because then that makes the founder think, okay, so what could be the various channels, or what could be the big branding that I could do?
Right.
So yeah, we do share all of those
Right.
things.
So, see, on that note, you mentioned a whole bunch of different aspects, but as investors, right, is there something that we do prioritize when we are building conviction on a business, right? Is there maybe one aspect that you put more, over the above, right? Uh, I think, of course, we want there to be the vision, we want the storytelling, we want the market to be there, we want, uh, the product market fit, etc., all to be there. But is there something you can prioritize over the rest? Prasun, Hithendra, in case you want to.
Yeah, I think from a business point of view, our learning is that money can't buy PMF, right? So uh, founders sometimes mistake that if they raise capital, they'll have enough time to find PMF, but honestly, that creates more of a problem. And I think that is what we try and prioritize. Now, different investors at different stages try and figure out PMF and the definition of PMF differently. At the slightly early growth stage, which is what we come in at, we try and see things like gross margin needs to be okay, because again, that is a sign of PMF, right, for us, whether the customer is willing to pay a premium for your brand. Go to market is another one. But essentially what we're trying to do, and these are more detailed things, right? What we're trying to figure out is, do you know what you're doing and is the product really taking off? So have you figured out what the customer value proposition really is? Um, and just on the mistakes on pitching, I think founders sometimes mistake that investors want all the answers and investors also want everything to be perfect. We like founders who say, we don't know. or we made these 3 mistakes. That's fine. It's okay. Happens all the time, right? So founders who come across saying everything is perfect and we know everything are actually quite scary. So yeah, that's what we
So
look
yeah,
for.
so on that note, has anyone on the panel, or I mean, I would love for one of you to share a really exceptional pitch perhaps you received, and what made it, really stand out?
Maybe I can take that one. So I think, say, I won't name the company. I mean, so I think what we essentially, liked in this specific story was, the quality of, the founders, personal struggle that kind of, led them to this, business, right? So that spoke a lot about, the kind of grit and, the kind of ambition the founder had, and also, kind of how they thought about, building the business more systematically than, the other, peer models, which were out there. So I think, just, adding to what, my co-panelists, mentioned earlier, we, start by looking for what is the quality of, customer insights that, founder, understands, right? So have they done the ground level research? So do they really know how the customer, thinks? So do they know what makes the customer think? I think that's the primary understanding that we look to build our conviction on. And I think, going back to that, founder story, I think she was really, out there in the field and, kind of, understanding. So how is it, that retailers are, looking at the business overall, how will the gross margins, kind of, improve and all that. So I think it's a lot about, ground proofing, the plan that they have on paper is, how, I would see that.
Hithendra, any pitch perhaps you also want to share?
See, we do, slightly later stage. We don't do very early stage, right? So, for us, what is more important than a good pitch is, so the way that we evaluate businesses, if the business is good, it's there in the numbers. If it's bad, it's in the numbers, right? Because a story is very important at a certain stage, but at least by the time that we start looking at a business, the numbers have to, speak ahead of the story itself. So we look at the numbers first before even we ask for a meeting, and then we hear the story after that. What is the story behind these numbers? So that's the way that we like to hear a pitch, if at all, because that's true for the stage that we look at. And I just wanted to just address one of the early questions that you asked, right? I think what are the one thing that I personally don't like? I mean, dislike is a strong word, but I personally just stayed away from is, see, a lot of entrepreneurs come when they come to us. The discussion, the story is all about disruption. And I think, see, and I keep saying this to many people, that you don't have to necessarily disrupt anything in this world, right? I think the world is perfect. You don't have to necessarily disrupt to build a business model, especially if you're in the D2C space, right? Because if you're building a brand, I think the way that you need to look at is as a huge opportunity. Demographics is the largest opportunity, that we have in front of us. You can build a business just by using multiple channels that's available, right? I think D2C is great. See, whether you're online first, you're offline first, really doesn't matter. As long as you can build a business model which utilizes this channel in a more efficient way, and if you can use your smartest and entrepreneurial ability to build a very efficient business, and efficiency is all about creating a sustainable business model, right? I think if you can just move the discussion away from how much capital we're raising to how much revenue we're able to generate, and at what efficiency that we're able to generate the revenues, I think that's something that we would like to focus on in our discussions.
Understood. I think we've heard from the VCs their preferences and what they sort of look at, and examples of things that they prefer to focus on, right? But I think at this part, I would love to involve the audience. If there is any particular thing that you feel you have been optimizing for your business, maybe a metric you're chasing, maybe something you feel that, if I really focus on this will really help me with my fundraise, right? Yeah, I see a hand there. Can we get a mic to, I think there's a table. Yeah. Yeah. I think it's the last table on the left side, yeah.
Hi, I'm Madhumita, and this is for Bhavna because she invests in early stage, and I want to know that a lot of emphasis is there on team. So many a times the entrepreneur is a solo entrepreneur without a co-founder, without a team to begin with. So what is your criteria when you are investing?
So honestly, it's very subjective. Okay, so early stage, let me tell you, if you're coming to us for the first round, right? Depends what are you building. In D2C, for example, if you already have sales, right? Uh, team, yes, I will look at, how many team members are there, who's supporting you, right? I would ask questions like, okay, let's say when you will scale, do you have people who will handle those part of businesses? Like, is there someone who's doing marketing? Is there someone who's handling operations, right? I just want to ensure that when we fund you, you would be able to execute. I mean, it's not necessary that I want 2 or 3 co-founders. I mean, there are some founders who are able to get a very strong founding team around them. So without even giving a tag of co-founder, they're able to make them work, like they give them equity, etc. Right? So I think case on case, it really matters. But what I want to ensure is that you know what is required for your business, right? I mean, if it's a business which is, let's say, execution heavy, then you need to have those people, or at least I want to know that you have a network from where you will be able to get those people, right? So I won't dismiss any company just because it's a solo founder, but I definitely want to look at the strength of the founding team.
Yeah. If everyone else can hear, otherwise I think you can, if you use the mic, it'd be easier.
Hi, hello. So I just wanted to understand something. Basically, we have an e-commerce business wherein we sell across marketplaces, but we don't have a very strong D2C brand primarily because D2C has been more of a cash burn that we've seen, especially after the changes of Apple privacy laws that have come in, where marketing costs has increased drastically on that channel. But whenever we try and talk to any VCs, what feedback we still get is, your Amazon business or your e-commerce business is not sufficient for us. We want you to build a D2C business, even though it can be a loss-making business for the next 3 years. So I want to understand if I have a sustainable business on an online marketplace. I understand it's not my own D2C channel, which is a direction that we want to take. It's not something that we are against. But why, in that case, why do VCs straight away say, we are not interested in your business?
So, sorry, if you can help clarify, you run a marketplace and you want to...
No. So I run a brand on
Okay.
e-commerce marketplace.
Okay.
And I don't have a strong D2C
Okay.
brand as of now because whenever I invested in that channel, I was losing money.
Okay.
And because we are not funded, and we tried to meet a lot of VCs for funding, but the feedback that we got was
Yeah.
Let me take that, right? I think, again, I'll give you my perspective, right? I think, it may be different for different investors. I think there's nothing wrong with what you're doing. And I think, which is what I said, right? I think everything is a channel. And whether you want to, say it's like, if you take offline, whether you having an EBO, exclusive outlet, is important, or can you be selling in a multi-branded outlet, really doesn't matter. As long as you're able to generate revenues with, reasonable gross margins, you're able to have, repeat customers. And repeat customers is all about growth. After having to pay for the channel, if you're able to make money, I think it's a great business to be in. It really doesn't matter whether you have, at least from our perspective, whether you have that direct connect to the customer or not, because, I don't think, HUL is the largest, consumer brand in India. I don't think they know who their customer is. They only know who their distributor is, right? And maybe they know the next level of who the retailers are. They really don't know who the customer is. So it's perfectly fine that, if you're able to scale it up without, bleeding money and building your own channel. But as long as, ultimately scale and multi-channel is what we would focus on.
Yeah, I think just to add on that, I think what you should take away from that feedback is not necessarily that you need your own D2C channel. I think what you should take away is you need to diversify your channel. And if you want to diversify your channel, you can go offline. It may still not be D2C, but the thing is you will at least have some negotiating power. The challenge is if Amazon, Flipkart tomorrow switch the channel and say, boss, I need to make money now, then you should not be the loser in that, right? Now, how do you do that? That can only happen if you have some leverage in terms of some other channels. And that is what I think investors are worried about when they see marketplace only as a channel. But completely understand, I mean, if you're starting up, you will start like that. But now that you have found PMF, try and diversify it to other channels.
I mean, just to add, I think one is the channel choices you're making. I think what is more important is the kind of brand equity you have built with the consumers. Let's say if you have built a strong brand equity through the marketplaces with the consumers, and there's a pull from the consumers at the retailer when you go offline eventually. In India, eventually you will go offline because 85-90% of the market is sitting there, right? So at that point, it should be a pull from the consumers and not a push from the distributors and retailers. And that will only happen if you have built a strong brand equity, whether you have done it through your D2C platform or through the marketplaces. I don't think that matters so much, to be honest.
Just out of curiosity, what sector is your, or what category is your brand in?
Travel and luggage accessories.
Okay. Yeah.
Hello, everyone. My question is to Mr. Hithin. You just said that your investment role comes on the later stage. So, can you please define the later stage and the early stage?
I mean, it's very different, right? It will be different for different things. But I mean, we are fairly, we have, I mean, from our fund perspective, we are fairly focused. For us, we want revenues of at least, let's say, 3 crores a month. And it has to be EBITDA positive at corporate level at that point of time. You know, and we understand that in a growing business, it's difficult to get to that point. And the reason why I insist on that is, see, and post our infusion of capital, we know that the business will become a bit negative, because if you're investing on growth, it will take some time to get back to profitability. The question is, the two things that we're looking to check in that, right? One is, does the entrepreneur has the mindset to build a profitable business or not? That's important for us. Number two, does the business have the ability to, generate profits at a certain at any scale? And if it does have, ability to generate profit at that scale, then you know that at a larger scale it can be, hugely profitable. Those are the two things that we look at.
So there is no set definition for that.
Pardon me?
There is no set definition for that.
Sorry, I couldn't hear.
No set definition for that, the later stage and the early stage.
So that's, I think I said the size, right? I think, it doesn't matter, how, I mean, if you can get to that point in, let's say, in a year's time, we're happy to look at it. Or if it takes you 5 years' time, it'll take 5 years' time. So, I mean, that's what I'm saying now. I mean, whether you call it early stage or later stage, it's like it could be different for different people. But that's why I said we don't do very early stage, right? So, we don't do, if it's a revenues of less than what I mentioned, and or the profitability metric has not been met.
Thank you.
I see a couple of hands up there.
Hi, my name is Kavita, and in fact, just to segue of what you were saying, in the last, say, 1 year odd, we hear these words of profitability, sustainability being heard repeatedly in the investing world. We have a panel who are at different stages of investing. I would like to understand at what stage does profitability become important for a VC to come in, and what is the expectation from a VC side on should you be profitable when we're coming in, or should be profitable, say, 6 months down the line? It will be great to understand that.
I feel every panelist should answer this question.
Sure. So maybe I can go first. I mean, see, typically, at least we come in very early. We come in at a pre-series A stage. Brands could be doing anywhere between 30-40 lakhs a month, all the way up to about 1 crore or 2 a month. So at least what we look for is, brands which have a decent gross margin depending on the category they are playing in. Because if you have a strong gross margin and then if you execute well, there would be a path to profitability. Definitely, it will obviously not be a CM2 positive business, and we are coming in. There will be significant burn at the EBITDA level. But I think the idea is that path to profitability should be visible, and the levers for that. What are the key building blocks or the levers for margin improvement over time? Whether you're talking about the CM contribution margin or the EBITDA margin, that should be clear to us. So there is a shape of business when we come in, but clearly something which doesn't change significantly is maybe the gross margin. It improves a bit, but it will not change drastically. But I think so we look for businesses with a strong gross margin profile, and that is driven by several factors. And we look for clarity on the margin levers, which will help it move towards profitability as the business scales from the stage we come in to maybe a growth stage and thereafter. So that's typically the way we look at it.
We all go? Or?
Yeah, I would love for you to go.
Sure. So we come in again at a later stage. than even Carpediem. So our smallest check size would be about 80, 90 crores. But most of the companies we invest in are not profitable at the time we come in at. So it's very similar actually. The way to look at it is my variable margin high? Because everything else can have operating leverage at some point or the other, right? So if you're investing ahead of time on things like branding and things like team, I think we are very comfortable with that because we've seen that journey of brands go from 100 to 1,000 crores and generate profits over that time period. But if you are spending your money on discounts and or performance marketing, then we haven't seen too much operating leverage there and it becomes very challenging. So that's how we try and differentiate.
I mean, I thought I already answered this question. So, for us, it has to be profitable at the time of our investment. Two things, right? And what we look at is similar to what, Prasun and Prayag are saying. It's gross margin is very important because, if you don't have enough gross margin, then you don't have a leverage. And if you are building a business to grow quickly, you'll end up spending a lot of money both on customer acquisition as well as on the channel. So post which, if you need to generate profit, then you need to have a higher gross margin. So that's very important. So so profitability is there, but we do understand that post investment, like I said, post investment it may go negative because you're going to invest for growth, but it should have the ability to get back to that point fairly quickly.
Do you have similar views or?
Yeah, I mean, so because we come very, very early, most of the companies, I mean, depending on the product they have, they could be profitable. And usually the situation is that they're profitable, but they know that they won't be profitable as soon as they fundraise and they scale, which we understand. So again, I think like my co-panelist said, we would look at when do they actually get profitable at the scale up stage. Let's say at 3 years or 4 years down the line, what would the numbers look like, right? So we do discuss all of those things, but of course, understanding that we invest in the first year of the business, right? We are ready to, well, I mean, the risk is very high, but we want to understand if this would be a business that would firstly, what would it look like when it scales and, when they increase the SKUs, for example, but yes, profitably, maybe 2 years ago, we were not talking about profitability as the first thing. But today, even in our intro calls, a lot of times we are discussing that, do you have a plan with your business, and how does this look like maybe 5 years down the line? So,
Understood.
Maybe I can just add my 2 cents to this, right? So I think profitability is something inherent to every business, right? So rather than going by what some investors are saying or what, the market is saying, I think founders should inherently focus on, whether your business can get to profitability. Just forget the number, but it's more about the conceptual, thing of, getting to profitability. Because I think eventually people will start looking at, free cash flows also, right? So as you start scaling the company. So if you can't kind of establish fundamental profitability of the business, when are you going to answer the free cash flow question, right? So, yeah.
Thank you. I see the time's up. Placard is ready, but I would love for us to maybe get in one more question. Okay, getting nods from there, but thank you to the panelists for sharing your views on how founders can navigate their fundraising discussions. Over to the host. Yeah.